Good morning. Today is the 24th of February and another episode of Two Grey Beards. We had a fairly quiet week, haven't we, Andy?
Yeah, except for the enjoyment of watching Nvidia move about and some of the tech stocks, it was quiet on the macro front.
Yeah. I don't know. What do you feel? I feel that like the market went up less than I thought it would on stellar Nvidia earnings. I think these macro stocks are getting a bit tired at these levels.
Yeah, I think so. The aftermarket for most of the stocks that are peripheral to the Mag 6 and those stocks definitely faded as Nvidia continued to rally. There was a lot of options activity in Nvidia and the related stocks, but I think cooler heads are prevailing outside of Nvidia, which by the way were fantastic earnings obviously. And the stock is if it's possible it's a fairly priced or cheap stock. But at the same time, it's interesting that they're selling to the Mag 6. The capex of the Mag 6 is being spent on GPUs.
Yeah.
And so the question that you have to ask is that a good investment by the Mag 6? Are they going to earn money by that? Are they going to have to continue to buy a significant amount of GPUs, et cetera? And I think the market's starting to say, what pie are we all eating from? And is there enough room for each of us? So overall, I think the price action was also heavy to me.
Yeah. No, I definitely agree. And the other thing that I've noticed last week, and we've got to talk about the price action as opposed to any macro because there wasn't any, is the just overall weakness in the commodity space. It just continues to be very heavy price action. Any kind of bounce is sold into, and that just doesn't chime in with what everybody's talking about, and that is an economy which is on fire and everything being wonderful and big reflation in equities. It just doesn't triangulate with what the price action actually is showing. And I'm going to talk about some indicators that I particularly got worried about on Friday in the price action later on in my segment, but it just doesn't feel like a market which is ready to continue higher. It just feels like a market which wants to go sideways at best and down at worst.
Yeah, I think you're right. As it relates to, I focus on oil and I've been writing a lot about China lately. I do think there is a case for energy, but the rest of the commodity sector is particularly weak. You have all the ags are in particularly the grains are very weak. And it's clear to me there's some doubt on the path of growth that isn't reflected in the equity market. So, yeah, I think that's worth paying attention to. I'm long a little bit of oil at Damp Spring and I'm long a little bit of China at Damp Spring. So, I don't think it's a throw out, we're heading toward a weak growth environment, but there is some question about it.
Yeah. And certainly the prices that we've attained discount so much that it's probably only natural for the market to hesitate at these levels. So, as we've sold calls against our QQQ position, and I'm very happy with that. Maybe we could have been even more aggressive and lowered the strike by a couple of points, but I think that we are in the right position for the time being. And I don't feel that we need to make too many changes. What about next week? What do you think? Big auctions, 170 odd billion worth of twos, fives, and sevens. The market is, fairly priced for them. We have given up a lot of the cuts that we had priced in. Now we are on top of three cuts for 2024, which is exactly where the Fed's dot plots are. And apart from that, all we have are durable goods and the Q4 GDP, which nobody's going to pay any attention to because it's all in the rearview mirror. And finally, we have the PCE on Friday, which we all know that every Fed governor will look at, but we already know what it is because it's a derivative of the two data points that we've already had, the PPI and the CPI. So very unlikely we get any kind of surprise from PCE. That would be news if we had a surprise from PCE. And definitely what we need to talk about really is the Fed's dot plots, which will come at the FOMC meeting in March, and what the likelihood for those is.
Yeah, for sure. And we got a little bit of a hint of at least the tone. Now, as Nick mentioned, we get no data this week, so this is relatively irrelevant for the week ahead. But the following week, we get Powell in front of the Senate and House, and he could make news. The week after that, we get inflation data. And the week after that, we get the FOMC. So it's something for next episode. But at the same time, the market is set up for basically, as Nick said, in the short end, trading at fair, assuming the dot plot stays basically the same. And the Fed continues to expect 3 cuts in 2024. We've got some evidence that at least there's a slight movement toward maybe not 2 cuts, but at least a movement toward 2 cuts that came from Fed speak, but in particularly a speech by someone who we think is particularly influential, and that's Waller, when he said in an extended speech, which is worth reading, "What's the rush?" And he was referring to cuts. And so we think he's at 3 cuts. And we think Powell is probably at 3 cuts, as is the median Fed governor, which is what shows up on the dot plot. The question will be is either in the Hill testimony or based on the data that we get in the CPI, what will the FOMC do? Will there be a shift of the median? It'll only take 2 voters going from 3 cuts to 2 cuts, but that might be hard to do. Will the median jump to 4.9 from 4.6? If so, that'll be a market moving event, and the market will predict it based on whether Powell says, "I'm moving" in front of Congress, or some hints at moving, or the CPI, PPI data comes in line or hot, or we'll just have to wait till the FOMC and see. But for now, 2 years are stuck with waiting for that type of information with a tremendous amount of supply.
Yeah, no, I completely agree with you. I think the 2-year is completely stuck at these levels for the foreseeable future. And we will only get a 30 basis point move in the dot plots after we have seen, or the likelihood will increase after we have seen the CPI and PPI numbers for February, which we get in mid-March. Those, I think, are pivotal because you can make excuses for the January number. You can say that it's seasonal. You can say it's a one-off. You can do all sorts of things. But if 2 on the trot come out, then the probabilities decrease. And I really can't see that 3 cuts becomes the base case anymore, simply because we're going to be running out of time. If they need to see several more months this year, then even June starts becoming dodgy. And as we all know, we have then the elections, and I think that they will be loath to start cutting in front of the election because that will be seen as political. And that only leaves 2 meetings after the election, which is November and December. And really the odds that they will start moving 50 basis points, unless the economy really weakens, are very low. So we could end up with 2 cuts this year quite easily. And then the market will be, certainly at the short end, will be 25 basis points, lower than it is at the moment. And that must impinge on equities and their valuation. And that's why I think that the likelihood of them just ripping higher from here is very low.
Mm-hmm. Yeah. So that sort of covers our macro outlook and what to expect for next week. We'd like to also mention to our viewers how to think about our portfolio and what matters. Nick, do you want to start?
Yeah, we've had a lot of questions about why are we at a certain level of allocation in equities and not higher or lower or whatever. What we would like to stress to you is that this portfolio needs to be a balanced portfolio for wealthy individuals who only want to make changes relatively few changes per year, and want to be able to talk to their wealth advisor and discuss with him when changes should be made. Personally, I think that what you need to disregard, and let's do an analogy here with driving a car. To me, it doesn't really matter whether I'm driving the car at 50 miles per hour or 75 miles per hour. What matters is when I brake and when I accelerate and why I do those things. If you think that we're driving this car too slowly, there is absolutely no reason for you not to be driving it faster. What you should be concerned with is when we brake and why we brake. And if you agree with that, then you lower the allocation to equities. Now, the other thing that is important to understand is that cash returns are particularly good at the moment. You're getting 5.25% on your cash. Unless you think that there is a very good reason to go riskier than that, then a 35 to 40% allocation to equities is not ridiculous at all. And I think that you have to understand A, where cash is, and B, what a balanced portfolio seeks to do. What do you think, Andy?
Yeah, exactly. We think a balanced portfolio does well when there's a recession and does well when there's a growing, robust economy. And you can't own just equities. You can't own just bonds to have a balanced portfolio. So what we do is we seek balance, and then we have a certain risk tolerance. And let's say we're old gray beards and we drive at 55 and we drive at the speed limit. That doesn't mean that you have to. You drive at the speed you want. Your own personal circumstance, the way you talk to your broker. Now, that said, just because I'm saying you should drive at your own speed doesn't necessarily mean that means you should have a higher equity allocation and no bond allocation, because that means that you've decided that you're going to be unbalanced to future outcomes and you're going to be exposed to recessions. So the best way to use our work is to say, okay, I like balance. That makes sense to me. I don't like the speed you're traveling. I want more return for the amount of risk I'm willing to take because I'm more risk seeking than you two old guys. And in that case, your job is to lever your portfolio, reduce your cash, increase the holdings you have, but in a balanced way. Then, and so that's the lever, that's your accelerator, is the leverage you use, the amount of cash you have on the sidelines. But it doesn't mean that you should be unbalanced. Now, you can be, that's up to you. Bet on what you want, but we like balance. And so the next step is what really matters from week to week, what the signal we're giving. Forget our allocation and that we're traveling at 55. We're saying that's our speed. We like balance. And then we change. We either accelerate in a particular asset class, decelerate in a particular asset class, or accelerate or decelerate on overall assets through time. Now you can push the accelerator harder or softer than we do. That's up to you. But the overarching concept and then the change in our allocations are the signal you get from us.
Excellent. I hope we've cleared that up for you. Now, let's talk about what allocation changes we want to do for next week, if any.
Sounds good. So I've been looking at the bond market. I know there's a ton of supply on the front end. I know that there is also a ton of as we said, the front end is stuck because we don't know what the dot plot's going to be, and no one's going to take big swings until after the CPI. And yet, the long-term bond market seems to be seasonal, set up in a way that favors the potential for upside in the next week, in particular, month end flows that might be pro bond and anti stock. But I like our bond exposure. I don't think we need to mess with that.
No, I think we are fairly balanced there. We have VWOB for the longer exposure. We have TIPS for the longer exposure. We have the belly, which is really not moving here at the moment. I think that's stuck as well. We've got rid of the 2-year because that was dead money, and we've got it in cash now, returning 5.25. So we have plenty of cash. We can allocate it whenever we see something that needs to be done. What I would like to do, and I think the commodity space is vulnerable, and especially if we agree that the potential for a squeeze is there for the bonds, is get rid of some of the exposure in commodities and buy gold instead, because gold would benefit from the bonds going up as well.
Yeah, I always like gold, and we haven't had it in a while. I don't think it's going to be running away, but as an enhanced way of owning sort of duration bond, I like it better than commodities at this stage. Oil's had a big bounce, and I think as I said, I'm long it in damp spring, but I think it probably can, and I think it probably can go higher. But I think gold is going to actually outperform in that environment as well. So I agree. So you're thinking to sell 2/3 of our.
Yeah, something like 2/3, but I'll mention that in my segment later on.
Okay, sounds great.
Yeah, I think that's all we have for you this week. It's going to be another relatively quiet week, but we feel somehow in our water that the equity market is going to stabilize or even give back some of the gains of the past week.
Yep.
Thank you very much indeed.
Have a
See
good
you
one.
next week, Andy. Let's start with the allocations. Naturally, all we did is we sold the QQQ to calls, which I haven't put in here because they're not in the money, but naturally they are in the broker statements. All you've got to do is download them. So what orders are we putting in for next week? Well, as mentioned, we are selling 600 shares of GSG and buying the equivalent amount of GLD. If we have a look at that, is approximately 2/3 we have in GSG. And we are unbalanced at the moment because we really need to have some gold. As we mentioned, we think the odds are that the commodity space is a bit sickly, and I'll show you a couple of charts in a moment. And we feel that risk is, well, I wouldn't say that we think that risk off is going to happen. We just think that we're in a period that is likely to balance risk. This idea that we need to go up 1 or 2% per week in equities is silly and is plain wrong. Periods of retracement and stability will happen, and I think that we are in front of one right now. This is one of the primary risk indicators that I look at, and it's actually the SOX index against the Japanese yen. And as you can see, it did a key reversal on Friday. So we think that has room to come down and therefore rebalance things. And if we look at ITOT over government, that's the totality of the bond market against the totality of the stock market, we see that it's very overstretched. We think a period of sideways would do equities a lot of good. And especially if we have a look at things like GLD over TLT, it indicates to me some more stability. So gold as opposed to going into commodities which are especially weak at the moment makes a lot of sense, and that is why we are switching, and that is why we are happy to remain short of those calls in QQQ. I think that if you wanted to be more aggressive than we are, you would probably lower that strike down to 440 or even 438 as opposed to 442. And, that way you become more aggressive than we are. But we certainly feel that over the next week or so, we're going to have a period of retracement in the stock market, and that QQQ has probably done as much as it is going to do in the short term. Anyway, thank you very much indeed, and speak to you next week.